Hey everybody, Spartan from SpartanTrading.com. I want to hit you guys with another trading educational video. This one I want to be specifically talking about different types of contract expiration and why we'd use a longer expiration date over a short expiration date and vice versa. So let's talk about some strategies behind this. Now, if I'm looking for a movement on a stock, let's say it's something like the EV industry, or maybe you're wanted to get into AI, or maybe some sort of tech or biotech, whatever. If you're going to be looking at taking something over a longer period of time, then you can opt out of a short dated contract for something long term. Now, when I talk about long term, I'm talking 6 months to years out. When I talk about a long-term contract, I typically refer to leaps, and that's what I'll typically trade. So a leap contract is a year-out expiration by definition. When I talk about a leap, I'm usually talking about January of the next year. Even if it's 6 months out, a leap to me is going to be that January expiration contract. So let's take a look at a couple examples here. Let's say I wanted to play NEO. I think it's got some prospects in the long term to go up quite a bit more. I may opt out of a shorter dated contract to grab something that is a longer expiration. In this case, I could be looking at a January 2022 leap. Now, over the course of time, these contracts, as the price would increase to the upside, if it increases to the upside, obviously they're going to increase, but not at the rate that a shorter dated contract will increase. The longer out the contract, or the further out the contract, the less volatility you're going to have within that price action. Now, why would I want a contract that could go up less percentage over a longer period of time? Let's say the market is very volatile, or this name, for instance, is fairly volatile. This less volatility or lower beta on that contract will keep you in the contract longer. You're not going to get stopped out as easy, and it's going to be much easier to hold this thing, long term because of that. If you're looking to make those, bigger percentage gains, which I know a lot of people are trying to do because they're sexy, you would look at a shorter dated contract. So if you see that, for instance, NEO was breaking out in the short term of a range or a downtrend, let's say it's breaking this downtrend here, and you think it can go towards $58, you could take something that's, maybe a week out or the same week, 55 calls, something like that. They're cheap. Maybe they're like 80 cents, 60 cents. As they push up to in the money, they're going to go up exponentially. You can make higher percentage gains in the short period of time if that's what you're looking to do. But if you're looking for more so a longer term move, you would go after something like a leap contract. Now, the cool thing with leaps is, obviously, it's a longer term contract. You can treat these as investments to some extent, where you can, go with a little bit more size than you would go with on a shorter term contract, because you're not going to have as much theta decay. It's going to be a less beta, or a lower beta, so it's not going to have as much volatility. And as it works, you can do, or you can sell lower or the same strike calls, but a sooner expiration date to raise cash or to pay for that contract. So if we're owning, let's say, a leap contract, 100 calls on NEO at January. Actually, that's maybe a little bit far out, but let's say I own 70 calls for NEO January 2022s, and they cost me, in this case, $19. What I can do in the short term, if I don't think that it's going to go to $70 in the next month, I can go after the February 19s, which are right here. Let's go to the 70s, and I can look to sell these 70s while owning the 70 leaps. At that point, if it's not at 70 by the time expiration hits, you make $329 per contract that you would sell against it, and that is going to basically reduce the cost of that $20 leap contract you paid, or $19 leap contract you paid. You can continually put on calendar spreads. That's what that is, a calendar spread, until that contract's paid off. And even when it's paid off, you can continue to do calendar spreads. You just want to make sure that you're going after a contract that you think, and from a technical standpoint, should not get in the money. So it's a great strategy for a long-term trader, someone who has maybe a smaller account that wants to grow the account, but doesn't like that short-term volatility in contracts to go and trade those leaps. If they have the ability to put margin on their account, they can do these calendar spreads over and over and over again to pay for those more expensive contracts. It certainly can be helpful. Now, like I said, if you're more of a trader that is looking for a short-term trade or short-term move in the stock, obviously the closer the expiration, the more volatile that contract is going to be. It's going to have a way higher beta. It depends on what fits your style and what you're trying to do. But, I think there's going to be a lot of probably smaller account guys watching this video. If you have a small account, guys, go after the leaps. Go after longer dated expiration. If you can sell or if you can do calendar spreads, good way to raise cash. Otherwise, it's going to be much easier to manage those types of positions. So that is kind of my 2 cents there. Hopefully this guy's helped you. And if you have any questions, you can go to spartantrading.com, send us an email there, or just hit us up, spartantrading.com, and there's a contact for us page. Anyways, thanks for watching, guys. Hope you enjoyed it, and I'll talk to you next week.